Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 30 minutes here on Options Guide TV. Well, it's interesting. Target did the same thing as Home Depot, but actually Home Depot was very interesting. Like kind of interesting how we framed our trades in Home Depot. It's almost like we knew what was going to happen because Home Depot did the perfect scenario, which very, very rarely happens, right? They announced earnings, the stock ran up and made our skip strike butterfly interesting right after the earnings report. And then they started to tail off almost instantly after the report. So after hours, it ran up. And then on the real market, it started a little bit up and then went back down. So Home Depot is now trading at a very interesting level for our open wing butterfly that we did. And our skip strike butterfly was, already a winner. We could get out of it for next to nothing. We could make our net credit on the trade. Granted, it wasn't as much as we would have liked. I think we brought in 20 cents from doing that trade. And like I said, I did that same trade on my own account. And then Tradier came out today, and they're down 3% or $3 because they trade right around $100 a share, and they're trading at 95.25. And also TJX is down about 2.25%, which is another retailer in the same type of space, a discounter, obviously, TJX. And TJ Maxx is what the name of the company is, otherwise known as. And so in that instance, that stock is down too. I kind of looked at that. If there was one I was going to lean a little bit more bullish on, it would have been TJX. Lowe's will be announcing earnings also here shortly, but let's go through these trades. We're going to walk through because I basically inside my x.com handle talked a little bit about the battle between the butterflies. So we got a lot to learn on a Home Depot trade, and I sent them all to the what if calculator inside the Tradier Pro platform. So that's where we're going to start. Let's go to the Tradier Pro platform. And the first one that we will look at is probably the most interesting trade if you have it on at this point in time. And let's send this to the trade ticket. And pull it up on the option chain. So here is the skip strike butterfly. We put it together in the what if calculator. We have the markets here at 375 from 397.50 up to 400. We still have this possibility that the underlying stock could come to that level. It's amazingly trading for about 4 cents. We're quite a ways away. But on the day of the event, I was able to close the trade out for a small net credit to the account. So what we needed to make sure that it didn't do is go beyond the 400 level. And so if we look at the chart, we'll pull up Home Depot. And you see that we came right up. We got to the 390 level, and we only stayed there for a second. And then we ended up down on the day. It's a red candle. So you may have panicked, I guess, for a smidgen. Wouldn't have gotten out. It didn't hit 400. 400 would have been way up here. Our bottom strike was 397.50. So at that point in time, the trade was looking really good. And you put it on for a net credit of 20 cents. You could have potentially got out for a net credit of about 50 cents. I ended up getting out at about a net credit of 30 cents when the market started to go back down. And then shortly thereafter, now it's actually trading for, it would be a net credit of 4 cents. So I should say that Right. I was thinking it would be a debit, but we'd have to flip the script and we'd be selling it for a net credit of 4 cents at the midpoint. But here's one of the wonderful things about this trade. Okay. So if you've watched Options Guide TV, there's probably a few of you out there that this is your first time watching, but we've always looked at the skip strike butterfly, and we can pop back out a little bit here. But we've always looked at the skip strike butterfly as alternative to a credit spread, not as an alternative to not as an alternative to a butterfly. So if you were thinking about doing a short call spread for a net credit, you'd look to probably sell one standard deviation move out, which would have been affected by obviously the volatility of the earnings. And as that alternative and that risk, we would sell that. And when the market ran up to 390, you'd be nervous. Matter of fact, you might have even panicked and got out. Ideally, I wouldn't get out on my short credit spread until it was probably closer to the strike price. And who really knows exactly where the price of the credit spread would have been. But with the skip strike butterfly, you bring in that net credit. You have the same amount of risk as if you put the credit spread on, but you have a buffer. You have that butterfly. You take part of the credit and you pay for the butterfly. So with that said, if I was in a credit spread right now, I would close it. I would pay a nickel. I would pay whatever I could to get out of the trade, because we got until Friday. The market is down. The markets are volatile. We got other companies that are announcing earnings. And obviously there's a very news headline-y marketplace at this point in time. But since we're in the skip strike, and I'll scroll down a little bit here and we'll zoom in a little bit. Now, why would I close it? I could bring in, I guess if you wanted a net credit of a nickel, if you wanted to make 5 cents, the midpoint is 5 cents right now. I don't know if you would get it, but because you're a -6 by 13, but the midpoint is basically 4 cents. So I would forego that 4 cents for a chance that for the rest of the day today, Wednesday, for the rest of the day, all day Thursday, all day Friday, that the market can start drifting back up this way. Unless it catapults up, and there's earnings reports, there could be catalysts that could drive it all the way up to 406 on a gap opening. But if it doesn't and it just starts going back up this way, you still have a chance on a 2.5 point wide butterfly to actually make above and beyond 4 cent net credit to the account. The maximum you could make would be $2.50 up here. That would be the maximum that it could trade for. So no reason to get out of the trade like you would if you were in a short call spread. You have the luxury of being able to stick around. Now, no big deal if you do close it out. Say you just want to go golfing or something. No big deal whatsoever. Go ahead and do the trade, because you do have a possibility that the market could start drifting back up. And ideally, you'd want it to slowly drift this way, and on Friday be trading somewhere within the wings of the butterfly. Okay. This butterfly. So then we went out, we did an open wing butterfly, which is a little bit more bearish, and we kind of leaned to this side on this trade. Let's send this one to ticket. And that is now trading for $3.15. And this trade is, well, it's interesting, right? In that we're 10 points wide. You could sell it right now and make about 60 or 70 cents on the trade. But as far as the butterfly is concerned, we're not quite down far enough on it. Here's where our strike starts, the 377.50. It's trading right here. We have a few more days. I would let this trade run. I think the path of least resistance is a little bit bearish on the retail space based off of the earnings. We see TJX down. We see Target down. Home Depot down. Walmart was down, kind of bounced back up a little bit. But in this instance, if we see this, we want to drift towards this by this expiration date. Okay. Now we did one more butterfly. Same strikes, but we just added a week. So this is trading for 311 right now, 310 we'll call it, make it simple. And in this instance, we're trading for 312. So, oh, we got to send that to ticket. I'm sorry. It should be a little bit more. 320, 390. Okay. So this trade with the extra week is trading for $3.90. And we put both of the trades on for right around $2.50. The market was moving when we were doing it, so it was hard to say apples to apples, but implied volatility was high. It was ahead of their earnings report. The 530, make sure we're right. Yep, 372 kind of makes sense. So this one is actually doing a little bit better, and it's mainly because you're at the money on this one option contract that is here. Now, if this drifts this way, so this is tough, hang with me here. If this butterfly goes this direction, the shorter term butterfly will do better, because what you need is the time premium to go away from the 367.50 strike. So the short term butterfly is not doing as well as the extra week out butterfly, longer term, but it has potential to do better as we head into Friday's expiration. So all three of the trades, no matter which one you did, are profitable. The skip strike butterfly is the trade that I did, and I was able to get out of the trade. I put it on for a 20-cent net credit, took it off for a 30-cent net credit the day after their earnings report. This butterfly we put on for about $2.50. We can now sell it for about $3.60. It's going to be it's almost going to be just like having a long put at this point in time with 2 days remaining. So if it goes up above the strike, this is going to drop precipitously. If it goes down, it's going to increase precipitously. It's got a lot of gamma in both of the expirations, and it's going to fluctuate. So it's really about where you think Home Depot will end up at the end of the week and what your outlook would be. You can obviously close it. It was an earnings trade. You did all right. If I'm ever doing a butterfly, if I can double it, I get out. So if I paid $2.50 for it and I can get out for $5, I would do it. The max upside is 10. 10 is almost impossible to get. So always looking to just kind of double on butterflies. If it came all the way down to this level and continued on down, you would have doubled too. $5, you would be selling it for $5, and anywhere down here, you wouldn't have to worry about it, right? You can let the trade ride and just close it out on the expiration date. But once again, if you're in this butterfly too, don't fall asleep on Friday. So I made the mistake of assuming on the show, and I've actually had some pushback on this, that if you do a butterfly and it ends up in the money, that I assume people are going to close it before the expiration date. In other words, you're profitable on the trade. You're going to go out and close this position because this long put right here is the right to sell stock at that strike price. And if you ride all the way to expiration and it's in the money, guess what? You're going to be selling stock at that strike price. You have the right to put the stock to somebody at $377.50. If that's not what you want to do, you need to close out the position. And that's one of the advantages of index options, actually, is that it's just cash settled. So if you do fall asleep, cash ends up in your account. Difference between the strike, if you're correct on your forecast. But in this instance, you got to know to close this out before the close on Friday. Just don't fall asleep. Okay, if you have any questions on the positions, let me know. Put it in the comment section of the trade. And next up that I'm going to look at, I figured I'll just keep going with some earnings trades. After earnings seasons as long as there's companies that I find interesting to trade on, we will continue to look at those trades. So though Zoom is announcing, but the only downside of Zoom is that it does have what am I trying to say? Well, it doesn't have the best markets. I'm sorry, I lost my train of thought for a second. So if we look at Zoom, the markets are a little bit wide, so you struggle a little bit with it. The at-the-money option contract is okay. Bullish outlook on Zoom, and we're going to, let's look at doing a skip strike butterfly. Don't mind the trade. Let's go a little bit out. They're going to be announcing after the close today. Pretty sure, right? And so we're going to target a little bit of the upside on this, in that market ran up heading into earnings. We're right here at 124. Yeah, this would be a tough spot for this to breach through 5 points higher. Even though we got earnings, we did get this long tail that's all the way up here around 92. So I think we target this area on the skip strike. 2 days remaining to expiration. They're after the close today. 150. Yeah, 180. I like, yeah, not bad. Okay, so let's try it again. Oh, let's try a 2-point wide one again. Like we were looking in everything that we've been doing right around $80 or Tradier was $95. So let's buy this one and sell 2 of these. Skip the 92 and buy the 40. Ugh, not quite there. 3 cents. Okay, so we're going to make it a ratio. See if we can get it done for 20. Okay, so here's the alternative, is to do a 1x3x2. So we're going to get rid of this one. We're going to add one here, 1x3, and let's buy 2 on the bid. No. I like the upside a little bit more on Zoom going into this earnings. So here, I don't, not a big enough nut credit. And if I look at that chart, I don't really want to go beyond the 88 level. If we break out, you're worried about the strong move to the upside. So I'm hoping to target right in this area. That is about, the expected move is $6. So you're looking at 89. So you're right in this area. The delta on that option is 25. All right. Let's lean bullish. I really wanted to do a skip strike. Oh, there you go. That's not bad. We moved up a little bit. And you'd have $4 of risk. All right. If that net credit, if I can get this done for 20 cents, I wouldn't mind doing it. All right. Let's send it to the what if calculator. And you know what? I'm going to do a butterfly, but let's lean it the other way. Okay, so this looks like the skip strike, but notice that there's a little bit of a steeper downside. Okay, so with the skip strike, we're a little bit more like this, right, on our TP. Now we do the adjustment. Now we're a little bit steeper, and I guess it would be on your screen. It's going to be like this. So this rise over run is steep because we're going to be selling 2 spreads to buy 1 long spread. If we can get it done, I don't like 10 cents. I want to get 20 cents for it. Means I don't know why it was at 20 cents for a second, but that's where I want to be. And I would leave it in there and do it. And if I can't get filled at that price, I'd leave it in there for an hour. We're at 83.25. 83 plus 6 puts us at 89, puts us right around where the chart is, targeting all this. Yeah, I think you might be able to get filled at 20 on this one. How wide are these? 5 cents, 10 cents. This one's a little bit wide. Yeah, I think you could maybe get 20 cents. That's going to be my, I'm going to call that. This is the trade we're going to look at, and we're going to say 20 cents. Okay. Now I realize that you might not get filled at that right at this moment, but I wouldn't do this trade unless I could get it done for a net credit of 20 cents. Fair enough. And then let's look at one other trade that's more likely to fill. We're going to just lean a little bit bullish. We're going to do our open wing on the call side of things. All right. So we want the stock to be able to reach our price in this instance. We're going to go 5 points from 84. Yeah, let's do the 5 points. Okay, so we're going to buy this 5 points right here. We'll sell 2 of these. And gotta go 6. Let's go 4. Let's go 4 just to make life simple. I would probably do 5 in my own account, but we'll do 4 for the explanation purposes. Because then this is 4 points wide, and then we're going to go 2 points wide around the 90. And we need to add one more here. And then we'll buy this one. Yeah, $1 to make 4, 1 to 3. And if you can double it and you get $2 off of the trade, that's fine. You're going to bet $1. If the market does drift lower, if it opens up 6 points higher, you're going to be right at the strike. You have 2 days remaining, so time decay is going to be a better scenario for you as opposed to Home Depot, who was on Tuesday morning. So I like this one better, mainly because Zoom is announcing earnings after the close today, and you have 2 days for the option contracts to live. It's a little bit lower price stock, so time premium isn't going to hang in quite as bit. The volatility is, quite a bit high. 116, you expect that to come down to 40, but 40 is a little sticky. I would like it to be a little lower than that if that's what the volatility collapse is. Yeah, I like it. $1, 4 points wide. I'd be willing to change this up and actually pay a little bit more for it. I like this trade though. Let's keep this one. We're going to send that. We got that in the what if calculator. All right. And then let's adjust one more time and we'll call it a day. If you have any questions, please let me know. But our earnings butterflies have done well. Pretty straightforward. Okay, 2 comments here. Anthony, what if you set up something bearish on Zoom? Okay. I kind of want to lean a little bit bullish. One of the things about Zoom, from doing some research, a little bit undervalued, and they're a software company, so I don't think they got headwinds as far as, well, everybody's got some issues with the trade war or some negative effects that could happen to the company, but these are the companies that I would lean a little bit more bullish on, Anthony. I'd want to lean bullish on Zoom, but I will set up something bearish, but I would do something very similar to the trade that we just did. The fact that we could get this done for $1 makes me want to go wider and risk more, honestly. Because with the butterflies, the wider that you have that first long call spread, the better the time decay on the short option, if that makes sense, right? Because your long option contract hopefully gets in the money, and what you need is that short option contract to actually decay faster. So the 88 area is interesting. If it blows through it, it's got potential to continue on up and set new highs. We look at this chart. Let's go back 1,000 days. But this isn't the only show that I've looked at Zoom on, right? So if you go all the way back to here, this is just a real interesting area on Zoom. If the earnings can propel it beyond that level, right? Especially if you get up to here. And let's go back even further. 2000. Too much. Got all the way back to the COVID days. 1500. Let's go 1500. We're still there. Okay, so right in this, but look at this just consolidation period. You know, just waiting. It wants to go somewhere. Came up to this level. This is the gap down all the way back here. This is where I was trying to focus in on. Right in here. So this is just a real interesting area, right, Anthony? So if I mean, you'd be tempted to get long zoom in this type of marketplace where you've got a software-based company that doesn't really have the exposure to the tariffs and everything right at this level. And if we break out to the upside, the company's still got solid margins. It's just not a bad company at this point in time. So I want to lean bullish. It would be a stock that you could almost buy a deep in the money long call on after the earnings, right? If you break through the 88 or 90 level. Okay, so you still want me to set up a bearish one? Here's where I would look at on the bull side. Okay, let's. A dollar I think is too little to spend on this. I'd be willing to. Let's buy the 80. Let's go a little bit in the money. Don't be scared to buy an at the money option. We're gonna sell 2 of these. That's 6 points, and then we go 3 points here. 92, and we buy this one. Yeah, 158, and the maximum upside is 6, and we're still at that, and we're a little bit wider here. We're 1 point up. Time to case. I like this one a little better. I'm gonna make this the official paper trade. Okay, I like this one better. I took the screenshot on the other one, but we'll look at both of these. All right, this is where I'm at. If I'm going to lean bearish, if I can get that ratio butterfly and I can pull up, it's not quite the same, but let's pull out. Let's zoom out if we can. Yeah, thank you. And there we go. Pull up Safari. Inside the playbook, I have it as a Christmas tree butterfly, but the Christmas tree isn't exactly the same in that. Come on. In that, and this actually wouldn't be a horrible way to approach this either. I don't mind this trade. You know, and this is what this playbook great. All right, let's go. Let's check it out. Let's check out the playbook. This is the Christmas tree, which is basically a 1x3x2, right? You buy a call, you skip over this, you make this one longer than this one. You're going to sell 3 of these by 2. Now, bottom line is that you are protected if the calls add up. So if you buy 1, you sell 3, and you buy 2, in that instance, 2 plus 1 equals 3. In other words, I'm buying as many long options as I am selling short. That means I have limited and known risk. And in this instance, all you're doing is skipping the front side and giving yourself more upside here and then less downside on this. It's actually not a bad way to approach this one. Man, I'm getting a little bit convoluted. You guys want to see it? Yeah, why not? All right, I'm hoping there's somebody out there that wants to see it. We're almost done. Okay, 11:31. 1 minute past. I want to throw this up because I think that from just going through this process, I think that the actual Christmas tree butterfly that's inside the options playbook is interesting. So let's clear this out. 6 points. Let's go 6 points. Let's go where at least the market's not moving on me and screwing everything up. Let's go to the 86 level. That delta's 38. We're going to buy this one. We're going to go 6 points to the 92. We got to go 85. Let's go 6 points to the 91. That's just too much to ask to get up to that strike. Okay, so let's see where this is at. Buy Christmas tree butterfly, baby. Here we go. 6, and then we need one more. 3, and then we're going to go 2 at the 3 level. And then there's no more additional risk. Now you're 92 cents. You're up to 61. You've lowered your risk a little bit. You have the same type of upside, but if it blows away the numbers, you could lose. But here's your Christmas tree. Interesting. 92 cents. We'll look at it. You're a good bit of ways. I mean, I don't think anything in this marketplace is, no, I shouldn't say that, is doubling the expected move after earnings. That hasn't really been the theme this week at all. I don't mind it. Okay, so what trade would I do in my own account? I think I would lean to the second. This one. I think this is where I would lean, and I'll decide if I want to do it today. This one 6 points wide for $94, right? Is that right? No. I didn't send that. This one's $1.54. This is the one that I would. This is the one I would lean towards. I don't mind any of them. The bearish outlook the bullish outlook has to pay off. The bullish outlook has to pay off. This one's $1.58. This is the one that I like the best. All right, that's it for this edition of Options Guide TV. I don't see any other questions and comments. We'll be back Friday and see how these butterflies pan out. Had a solid, I would say 80% winners over this earnings season so far. I think that's about where we're at on very short-term trades. So I maybe just jinxed myself, the announcer thing, right? We've been leaning bearish on most of the earnings announcements on the stock prices after the earnings announcement. So we'll see. We'll see where we're at. And then maybe next week we'll go back to checking out some SPX trades and trying to make a forecast on direction. Didn't do as well on those recently on the direction ones. It's just been tough. News headlines are hard to try to pick a direction on Monday to make it through the week. That's it for this edition of Options Guide TV. Please check out Tradier, the Tradier Hub, hub.tradier.com. I don't know where you're watching the show at, but if you go to hub.tradier.com and put in your username and profile, you have access to all the great speakers that Tradier sponsors and all the events that they put together to try to make their clients and everyone smarter option traders. So appreciate it. Appreciate the support. We'll see you this Friday, 11 a.m. Eastern time for the next edition of Options Guide TV. Thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.